Mr. Aaron Smith
Yes.
of Superfund, the future of investing. Good morning to you, and thank you for this interview.
Thanks for having me.
Well, I would like to start by asking you about Superfund. Who founded it? When was it started, and what does it invest in?
Superfund was founded by Christian Baha, a gentleman from Vienna, Austria. In the early 90s, we started to develop software. Our core competency was more in software development than anything else. And what we realized in the early 90s was that we could use models and software that we've developed to trade markets more efficiently than we could if we were just trying to trade it ourselves as portfolio managers. So in 1996, we launched our first product, which is the Superfund A strategy. Today we have about $1.7 billion under management and around 50,000 investors worldwide. Since we started trading, the average return in the Superfund A strategy has been about 18% per annum.
How many years again?
Over the past 12 years since we started trading. It's important to note that we achieve those returns also through bull market cycles and through bear market cycles because of the flexibility we have as a managed futures fund. We also were able to achieve a very low correlation to stocks, bonds, real estate, other commodities, even to hedge fund strategies. So our correlation coefficient is very, very low. For example, in the past 10 years, our correlation to STI, the index here in Singapore, is minus 0.1%. So the utility is that any investor could effectively reduce the risk of their holdings simply by making an allocation to a managed future strategy like Superfund. How is it possible? Well, we are trading in over 100 markets. Everything that is a very liquid futures market, from stock indexes, interest rates, global currency pairs, that being about half of the portfolio. The other half of the portfolio being energies, metals, agricultural products, livestock, as well as grains. So you can see that it's a very broad diversification, but also we can benefit from the uptrends as well as the downtrends in the market because we're able to take short positions as a futures trader. So this is also making managed futures, I would say, a very robust trading strategy compared to hedge fund strategies, or especially compared to traditional investments that could only make money in a rising sort of bull market scenario.
Okay. Are you different from a lot of the funds that currently operate in Singapore?
I think that we're different in the sense that we have a unique trading strategy. I think we're the same in the sense that we're registered with MAS as a restricted scheme, so therefore it's available to Singaporean investors. I'm not aware of any fund which has a trading strategy quite like what we have that's available directly in Singapore. So I think that's unique, what we do. But I think investors are increasingly looking for absolute return strategies, and managed futures is typically the best place to find that because if you look at hedge fund indexes, you see that the typical hedge fund index, like the HFR hedge fund index, has like a 0.5 correlation to the stock market. That means that hedge fund strategies, sometimes when the market is in a bear market phase, they're not necessarily making money, they're just not losing as much money. Whereas a managed futures fund can do very, very well in a bear market. So for example, our best trading month we ever had was September 2001. As you know, in that very difficult market environment, every other strategy was mostly getting hit. Our funds were up between 17% in the A strategy to as much as 33% in the most aggressive Superfund C strategy. So, and this is not just a one-time thing. If you look at managed futures funds since 1980, so the past 28 years, 80% of the time the market crashed, we had a positive performance.
What about now, Aaron? Markets are crashing all over the world. How are you doing?
Yeah, well, we're performing quite well. If you look in February, April, May, those months were months where we had very nice performance. Those are months also when the market was getting hit particularly hard. Recently, we saw big reversals in energy markets. So in that instance, we give back some of the profits that we've achieved this year. But the Superfund A strategy year to date is up 8% as of last night, the end of trading. Our more aggressive strategies are up a little bit more into the double digits. So I think it's a very rare investment strategy that can generate a profit in this type of environment. But at the end of the day, a managed futures fund like Superfund is going to do well when we see very strong trends or very clear directional volatility that we can trade. The assets that other managers spend on trying to figure out why a market should move, we're not interested in this. We just look at the price action, we look at the technical information, and we trade the breakouts. So it doesn't matter fundamentally why a market's moving, it just matters that it's moving, so we follow that trend. We've identified trends using our model, and then we will allocate a small amount of risk to that trend, so less than 1% of our assets. If it goes in our favor, we just tighten our stop orders, and if it goes against us, we stop out for a very small loss. So it's a very simple, cliche sort of idea that we cut our losses quickly and we let our winners ride. But in practice, it's very difficult for traders to do that. And by using a system, it really forces us to stick to that discipline of cutting our losses and letting our winners ride.
So what's your view on the oil markets right now? As we speak, yesterday, I think there was a temporary dip almost to the $100 mark. We haven't seen that for 5 months at least. It's fallen since July, 2 months ago, down by $47. That's a big decline.
If you look at a very long-term moving average or a very long-term trend channel, you see that the very long-term support's close to $100 a barrel. So we think this is just a normal pullback in the price of crude. Any bull market is going to be accompanied with reversals. So this is totally normal. I think in the 80s and 90s when the stock market was booming, we also had those times like 1987 where it pulls back. So that's just a period today in oil is no different than October 1987 for stocks. If you have a long-term view, you could see this as an excellent opportunity to get long oil. As a short-term trader, I can't make an advice. I mean, it can go up, can go down. That's not our business. But from a long-term perspective, we would be quite bullish on commodities in general, but especially oil, because the total amount of oil in the world is decreasing every day. There hasn't been a major elephant oil field discovered in over 35 years. Unlike US dollars, which are increasing every single day, oil is decreasing every single day. So it just makes sense that oil relative to dollars will increase. It's just sort of a common sense view. But we certainly see that oil could go to $180 to $200 per barrel in the next 2 to 3 years.
Right. So your fund, would you consider it a short or long-term fund? So if oil is going to touch $100, are you going to start stocking up now, or are you going to play the short-term up and down?
Well, we're a trend follower. So although our view, if you were to speak with Mr. Baha, the founder and owner of Superfund, he has a quite bullish view on oil, that we can achieve $200 a barrel in the next 2 to 3 years. It was just in 2005, 2006 when Mr. Baha was calling for $100 per barrel of oil, and everyone thought that was pretty aggressive and pretty extreme. But now we're looking at $100 as the low point. So we do believe that in the long run it can go up quite high.
Yep.
From a technical trading standpoint, we're just trading the trend.
Okay.
So if there is a clear downtrend in oil, we can benefit from that by taking short positions. So we can follow a downtrend in the crude oil.